Hey everyone, welcome. It is 1 p.m. We just got the closing bell for Monday, December 4th. I just got a trade that executed 1 minute before the close. So I thought it might be kind of interesting to take a look at that trade, and we'll throw it into option strat so we can track it. So I'm going to go over here into option strat and add in one of these Zoom controls are in the way. I'm going to build a long call butterfly. Okay. So this was in PETQ out to January 19th, and I was executed on a going short the 20s, going long the 17 and a halves, and long the 22 and a halves. And we did 4 of these. Okay. I guess the number doesn't really matter, but we're just taking a baby amount of risk over here. So max loss is only $100. And actually that's not necessarily true because I got executed at 75 cents. So let's get these proper prices in. $1.48. And -8. We did this one at 43 cents. So it looks like where we really gained some was on this one, where we got in at 13 cents. That's right. Oh, okay. So 4 times 75. Something's wrong here. My het Q Jan 19th, 22 and a half calls at 22 and a half cents, 13 cents. 20 calls at 43 cents, $1.48. Okay, let's just do, okay, this is why. There we go. Okay, perfect. So $300 at risk, maximum profit, $700. So what you see here is that this is a very high reward to risk ratio, although I'm probably going to only shoot for about 1 to 200%. So I'm only going to look for maybe even less than that. I'll probably look for about, maybe 100%. So I'm only going to look to make about $300 on this trade. But for me, for this particular setup, it's a high probability. So about 70 to 75% win rate. And then if this is just a 1-to-1 risk reward ratio, that's a very favorable trade. And if I hang on for even longer, so up to $600, then that would be a 2-to-1 reward risk ratio. But I'm not chasing it that high on this particular trade. I'm only going to look for that 1-to-1 reward risk ratio. But I thought I would share that since I got executed right before the closing bell over here. I didn't think it would get executed at all. So this will be an aftermarket. And we did this 12/4/2023. Just be an interesting trade for you guys to see and track as we move forward. As this trade progresses, I should say, you should see how the profit progresses. So here it thinks I have a 6.7% loss right away. That's quite a loss for just 1 minute. But what happens with these, especially with butterflies, is that you get the widening of spreads at the end of the day, and it affects certain legs a lot more than it affects the ones that were short. So the ones that is giving us money, that's creating this big spike right here, it gets affected a lot less than this strike right over here that is that we're buying in order to create this shape. So for that reason, it looks like we have these at the very end of the day, these very large gains and losses, but they're not real because once the market opens tomorrow morning, they'll tighten back up. So This will be an interesting trade for you guys to watch and learn. This is a little bit more advanced trade. It's more advanced structure. It's a spread. And sometimes we do worry about liquidity in these. And sometimes we worry about certain legs getting called away. And if that happens, since we did sell these, it's possible that we could get called. And if that happens, then we have a little bit of a trade management issue to deal with. So that's why normally I don't teach these more advanced trades very often unless you have a lot of experience. But professionals will use these types of trades all the time. A real professional institutional trader, this is one of the favored structures because you can get really good reward to risk ratios. So sometimes we structure these and we get a 700. So instead of a max profit of $700, it would be a $2,100 max profit. So we get 700-800% reward risk ratio sometimes. So they are highly favored by professional traders. In any case, let's take a look at what happened in the market. So we went up, we traded up at the open. We bounced exactly off of this Friday low just before the market opened. We went up, ran out of steam, and then we came down sort of in this unidentified region. We guess it would be the consolidation region from Friday, but we didn't draw a line there, and then went up and through and just chopped around its VWAP until the very end of the day where we went higher. So this is exactly what I was talking about in the morning video. When we open significantly down, it becomes, or significantly away from the close price, it becomes very unlikely for us to recover enough for us to go in the opposite direction. So in this case, we gapped downwards, but even though net we are a little positive on the day, it's very difficult to overcome this huge amount of distance to get all the way back up to the previous close. So we are pretty much very, very well assured that it's going to be a down day. So even though we recovered some, so we were down 0.53%. Even though we're down that 0.53%, all we really did was come in and touch that EMA 8 again. So the S&P 500 is really just chopping sideways, and it's looking more and more like we're just going to chop sideways into touching that +1 ATR. Doesn't necessarily mean that's what's going to happen. It's just looking more and more likely that that's going to happen. And if it does that, that means we're chopping sideways for probably at least this week, if not the next week. And then the following 2 weeks, we're going to get very low volume in the markets because of the holidays. So if we chop sideways for another week, then chances are we'll chop sideways for the rest of the month. And this will just be a very flat December. Otherwise, when we look at QQQ actually did pull back. It did come back and touch that EMA 20, which is one of the places where I said also because that begins to fill the gap right here. So it doesn't quite. Normally we have a gap fill of at least half the gap, and half the gap would be over here. The full gap would be down to here, but we did touch that EMA 20 and at least fill some of the gap today. And look how we rejected that EMA 20. It came all the way back up right here. So this is possibly, and actually a higher probability than not, that this is a bounce off of the EMA 20. We'll really need tomorrow for a confirmation bar, or anytime in the next 4 days, we're going to look for a confirmation bar, which means a green bar with the close above the previous high. That is going to be a confirmation of that bounce off of that EMA 20. So if we bounce in the QQQ, and the QQQ is what's leading or keeping the S&P from continuing to move up, that gives us freedom for the S&P to move upwards, in which case then all we would have gotten was that consolidation in the SPY before we moved higher. In the QQQ, we did get that pullback. Maybe we'll pull back even further and fill this whole gap. We don't know. But even if we just bounce from right here and this is the pullback, it was a very mild pullback, that does give us room to move a little bit higher at the very least. And the other reason that it gives me, I feel like this could be the bounce is, remember this whole time we were talking about touching that +3 Keltner channel and then at least pulling back to the +1 ATR. And the S&P touched its +3 Keltner channel, and now it's at its +2 ATR. We haven't hit that +1 ATR yet, but in the QQQ we have. Actually, we touched it this last Friday, and today we pulled back even further to EMA 20 and then recovered some. So this is possibly, if it's going to be a mild pullback, this is it in the QQQ. And then if the QQQ bounces upwards, then we're not going to expect the S&P to pull back as well. We're just going to expect it to go flat and then resume upwards. So that's, at least in the tech stocks, we've seen the crack, we've seen the pullback. It is possible that we could pull back even more. There's still room for further pullback, but we won't be surprised if we start heading up from here as well. So if that's the case, if this is truly the bounce, then we could start to see the Santa Claus rally happening in December. Then we could get directional in the next 2 weeks and then just go quiet for the end of the year, in which case we're probably not moving up that much. We've been over that a couple of times now, where there's all sorts of resistance up here. And after such a huge run in November, we're not expecting it to go super high anyways. Let's just take a quick look at the market rotation or sector rotations that happened today. And just to see if it confirms our Dow to, or sorry, the QQQ, the tech stocks to the Dow Jones sector rotation. So we definitely have technology down at the bottom over here. It's the very last sector in terms of industrial sector. I do have some commodities thrown in here and markets just to compare. But in terms of industrial sectors, the K technology and communications are at the very bottom. At the top, we had basic materials. Okay, so that's definitely Dow Jones related. We have some real estate, some retail. That's a little surprising. And some staples right here. So yes, it does look like we are engaging in that sector rotation on a day-to-day basis. And we're just really going to expect this to continue. We're going to expect even if QQQ bounces and XLK bounces and XLC bounces and starts to go upwards, we're still going to expect them to underperform relative to the basic materials, the staples, the more Dow Jones, the more blue chip types of stocks. Let's take a look at volume. Let's see if we've got any significant volume. The answer is no, we do not. We're still below average volume. And at some point for this market to get directional, we do need to get volume up. We've been sitting on low volume for 2 weeks now, maybe a little more than 2 weeks. We really do need to see that volume come up in order to give us direction, especially since we're going to expect that volume to drop off the second half of December. So if we just go back and look at last December and just see what that volume did. Okay, so here's December. You see how towards the end of December, we dipped way down, but before that, we still expected good volume. And then we dip down over here when we get to 21st and then forward. And we should really see that same pattern every single year. Over here in December, this December was low for almost the entire month, actually, and then was very low at the end in the 20s. So it's a very seasonal pattern, and it's very predictable based on human behavior. People just take vacations at the end of the year. That's just the way it is. A lot of companies give people time off. And then the markets, even though the markets are open, there's plenty of people and senior traders in institutions who take that time off to be with their families, take their kids on trips. And that's why we expect this volume to drop off at the end of the year. So I think that gives us a pretty clear idea of what to expect. What we're really going to be watching very carefully how the rest of this week develops, because that could give us a very clear picture of how the rest of the month is going to go. So we'll just have to wait and see for the rest of this week. And again, we have that economic numbers that this week we had at the beginning, at the end, some large economic numbers. So Friday especially is going to be important for us to watch. Other than that, there's not that much to be looking at. It's going to be a pretty quiet month, most likely. So these videos this month in particular will probably be a little bit shorter than normal. And then once we pick up in January and capital needs to be allocated, right, we're done preserving our profits and preserving our capital for our bonuses. We're going to start trading again in volume in January. So we'll see activity really pick up at that time. And then we'll probably have a lot more to look and talk about in these videos. So that's it for today. Enjoy the rest of your day, and I will see you tomorrow morning.